setups if you just focus on the issue of break of market structure. Okay, so there are two types of break of market structure. Okay, we have the continuation break of market structure and we have the reversal break of market structure. Okay, so these are the two types of market structures break that we have. Okay, so we have two types of break of market structure. We have the continuation one and the reversal one. Okay, so when we talk about the continuation break of market structure, we are talking about a continuation of price breaking. It can be the high highs or the lower lows. Okay, so if we are in a bullish trend, like what you see here, let's take an example in a bullish trend, like this structure here. Here we are in a bullish trend. Okay, and so if we are in a bullish trend, we tend to form high highs and high lows. Okay, the market tends to form the high highs and the high lows. That's the criteria of a bullish market structure or an uptrend. And that's the first thing that I'm going to explain to you about the continuation and break of market structure. Okay, so the continuation of break of market structure is, as I said, is the break of either high highs if we're in an uptrend, or the breaks of continuation break of the lower lows if we are in a downtrend. Now, this is an example of a bullish market structure, or in another word, an uptrend. Okay, and the first thing is, let me show you this is high. Okay, this was the high that was formed by price. Okay, high and okay, higher high on this is now. So now you can see how price was pushing price to the continuously highs. What we were just pushing to the upside. We were forming high highs. Okay, we were forming new high highs and breaking the previous high highs. Now, this was a continuation break when you talk about a continuation break of market structure in an uptrend. So let me show this example here. You can see example lower lows and lower highs. Now we'll mark the lower lows and lower highs. So this when what happened? Price broke this what here and formed this. What price did here is price and formed the new what? There. So now this is a continuation break of market structure in a downtrend, and you can see this. You can see like that. Now price was continuously breaking lower lows and forming new lower lows, and that's how we form the continuation break of market structure in a downtrend. Okay, but when you talk about price breaking structure in an opposite direction, okay, like here we are in an uptrend. Let's take an example in an uptrend. Like this is, let me delete the downtrend one. Okay, delete this one. So let us focus much more on this uptrend. Okay, into this, forming this continuation break of structure. We are breaking structures in an uptrend. Okay, we are not breaking structure in an opposite way. Okay, and in one of the criteria of break of market structure is that break of market structure are not criteria of a break of market structure. I'm talking about the criteria of an uptrend. Okay, so in one of the criteria of uptrend or bullish market structure, we always have to make sure that price doesn't break this level. Okay, never break this, higher lows. Okay, price should always respect this higher lows. Okay, price should never break these higher lows in an uptrend. Now, the continuation break of market structure, we already know it. Now we are talking about the reversal break of market structure. A reversal break of market structure is that break of market structure that goes against our trend. It goes against our direction. Okay, here we are in an uptrend. We were higher highs, but also we expected price to keep on respecting the higher lows. Is when price break in an opposite, a new trend. Okay, a new trend in the market. That's where we say, oh, now we are showing we can be observed here. When price takes this, market is as what the market is now showing what we call for this reversal break of market structure is what most people know. It's what we call the market structure shift. Okay, so reversal break of market structure is the market structure shift, or in other words, people call it change of character. Okay, so this area with the red line, this is where we mark our reversal break of market structure, which is commonly known as market structure shift. Okay, so for you to actually understand these two concepts, you just need to understand about the criteria of what? Criteria of a bullish trend and criteria of a bearish trend. Okay, so it's simple like that. I have in details. Okay, so if you Okay, and I think it will be easy for you to understand what I'm talking about now. A reversal break of area here. This is the initiation of that change in that what we call this break here is what we call a reversal break. It means price broke in the direction that we expected the price to keep on respecting, but price decided to break that level. Now, why do we always expect all this thing as a transition into a bearish trend? That's why we say the market is trying to move from buyers. Okay, so it's very important to understand that. And another thing is that when the market forms what you call a transition or a market structure shift or a reversal break of market structure, we always expect to see two things. It can either be a consolidation or it can be an expansion. Okay, market can either consolidate after creating this market structure shift, or market can actually continue expanding and just forming new lows and new highs. Okay. But also what's important is to understand about the major structures and minor structures when you're trying to deal with break of market structures. Okay. So sometimes when you go into the real charts, it's not going to be easy as what we can see in this illustration here. A little bit complex. It's not going to be easy as this. Okay. And what I mean by that is that in some of the I'll show you in an illustration some of the examples. For example, we have this card the upside, and then we break that point. Before we break this high, you may find that price inside here, price structure, you may find an area of liquidity now. Some of the terms at this level, we call that as our minor structures. Okay, so this whole area we call this as an area of liquidity. Okay, so you may find this especially in the higher time frame, but also even in the lower time frames. Liquidity. Okay, so this is an area of liquidity. Okay, this is an area of liquidity. Area of liquidity. This whole shaded area here. There's an area. This kind of structures when you go into the real charts, it's going to be a little bit different from what we see in this first illustration here. In this illustration, break of structures. So, but in the real charts, you may find some sorts of this kind of area. You have some sort of against a minor structure. You see the market showing you those criteria of on whether to of entry, okay, or as your point of interest, maybe sometimes even this one. So it's the market giving you that, okay. So have those inside high mark frames, so that we actually high there, yeah, high low, okay, liquidity, okay. So an area of liquidity is always from the high to the high low if we are bullish. Now these minor structures which shows you some bullish trend. Point of interest am I going to use? Some people call these areas as what? Formations. Okay, some traders call you actually use concepts, but everything ends up into as long as it gives you money, it's okay. So some people call these what? Formations. Okay, and for this kind of formation here, we can call them those formations and whatever. I'm just going to focus on trying to explain to you about how sometimes the real market is always complicated. Okay, this is this one that I'm explaining right now. And this is what always appears in the real charts. You find the market showing you clear bull interest or your area of liquidity. You find more than one point of interest. Okay, you can call it demand zones. So you have more than two or more than one, okay, point of interest or formations. Okay, which kind of zone am I going to use for me to actually look for? So there are always concepts to help you so that to actually simplify it. Now you don't know if you use targets. Okay, this is the real market, and that's the reality of trading. Okay, in the real charts we find this kind of confusions a lot, many times. Okay, and what is important for you to do here is to actually use the area which is unmitigated. So for the area which is still clean or unmitigated, as I say, I also look for an area which has a displacement. Okay, there are some minor structures you may find yourself like there is no clear displacement. Okay, clear displacement. There's no clear displacement that actually leaves behind some sort of imbalances. And if you can find what you call sharp turn, or call formations, if you can find one point of turn, that's become a much more nice point of interest for you to actually take your trade. But also, if you may find a breaker and a fair formations or your point of interest, that becomes much more of a high probability point of interest. Okay, but also if you find an area where actually you find the market showing that what we call the market has already grabbed the liquidity, some sort of turtle soup, and then it formed that kind of structure that become much more of a high probability setup. So we have different kind of things that we can use to look for a high probability setup. But also it's important to use the concept of premium and discount. Okay, when we talk about premium discount, I think if you don't know about the issue of premium and discount, I have that video about premium and discount. You can just go and check in one of my videos. Okay, and I'm sure you just understand. It's a very simple. You are that swing high and swing low, and then that all can say that dealing range, and then from 0 to 50% of that dealing range, that becomes the discount area, and from that 50% or equilibrium point to the 100% or 1%, if you're talking about 0.0 to 0.5 and 1, it becomes your premium zone. Okay, now it's very easy. It's very easy. Okay, so for me, for example, if I want to show you an example of a premium discount, I start from this high here. Okay, market increase size. Okay, so I can mark it from there. This can be seen. So I can make it, that's my, if I'm going to look for a premium discount, I just mark from, I just divide it, I just mean like that. Okay, so it means from this point here, from this high low into this mid, and from this point here, which is the half of this whole gun box, or this area here, it's going 100% or 1%, this becomes my premium. Still confused, and this is my area of interest. You don't know, you're still not sure on whether to execute on which kind of point of interest. Now you use the concept of hidden and mitigated point of interest, or you can use the concept of displacement and formation of fair value gaps. We can use also the concept of turtle soup, and then it becomes much easier for you to actually trade. Okay, it's not complicated. It's the real market is. So now let's just check it from here. Okay, you can check from here. We had this movement to the upside. Before we had this movement to the upside, before we had this movement, price was just dropping. Okay, it's area. Okay, got the last break of structure from that area. This was structuring a downtrend. Okay, now what happened here? Price. This was the last T. You can say this was the last T. What? The last lower high. Okay, this was the lower. This was the lower low. Lower low. That's one with the lower low. Last. Okay, this area here, that's our last lower. Finally, price formed these ones, and price failed to break this lower low. Did what? Price formed this failure swing. Okay, this failure swing here, which was our previous lower high, now has been disrespected, and the market is showing a transition now. So this is what we call market structure shift. Okay, market structure shift, but we are going to actually mark it when price breaks with mark this market, okay, with the body of the structure shift. Our first sign that the market is changing direction from a downtrend into an uptrend. Now, this is the first or we can say the first or the initial. Now, what happened? Price pushed up to this level, this high here, and formed what? And formed a high. Okay, so this high, and then what happened? Price moved down a little bit and formed this higher low, and again we had this, and this is the higher low, and this is the higher low, and then again we had that high. So let us check it on how actually sometimes it can be complex in understanding with the real charts. Okay, here we have it. Now this is, then we had this high. Okay, so we had this, so the high low, and higher. Look at those high highs and high lows. So that's how simple it is in understanding break of market structure. Okay, now so we have in marking the high highs and high lows is also different when we are talking about the market structure. Price in this, we to mark this as our break of structure. Okay, this one, the fake break of structure. So sometimes we mark this as a liquidity kind of. The true break of structure is high here with this body and crossed above this higher high with the body. So you can see that was the true break of structure there. Okay, but what happened here? If you about, okay, so this was our let's say this was, let's say this one, this last break of structure here was our current area where the market actually did what? Where the market formed the last break of structure. Now we are going to ask ourselves, where are we going to take our trade from? So let me just replay this. Okay, when I talked to you about how complex the real chart is, and now I just want to show you on how in the real chart you can actually see how complex that thing is. Okay, so look at this area here. Okay, let me just maximize my screen. Okay, so let's check it now. Okay, I talked to you about how sometimes we form minor structures and they are a little bit. Now this is it. You can clearly see. This is an area of liquidity. Okay, liquidity here. The market has minor structures. Why? Because inside this area of liquidity. Okay, is our area of liquidity. Price formed what? Price formed. Look at them. Let me just show you these ones here. So we had this, the first high low, and then price broke this body of the candle, and that's where we marked as our true break of structure. Okay, but as I said, it's in 3 charts, and this is in one of the examples of it from this area. And now you don't know from where you're going to take your entry. Okay, you are confused now. Okay, like you have to, the first criteria is to look for the clean or unmitigated. You can say this. Let me just remove this. The first is to look for a demand zone or a point of interest, or the first one. This one here is already mitigated. Okay, you can see price came down. It's not, now this is already mitigated, so we are not going to use this. And you can see this. So already we have 2. Okay, now you may be confused now. Which kind of point of interest are you going to use? Are you going to use this, or are you going to use this one? Okay, now one of these areas here, they are very high probability trades. Okay, very nice. You can use any of these, but you have to choose one which is high probability, so that you may not risk more than what you can afford to lose. Because someone may actually buy from this first order block, but the stop loss will be below this high low. Okay, this one, this order block here, or point of interest, your stop loss is going to be below it. Okay, now what are you going to do? Remember what I said on one of the things to consider if you want to choose the best point of interest. Okay, another thing I said is to look for what we call a turtle soup. Okay, that's what the second. And the other thing was to look for a sharp turn. What do we call a sharp turn? A sharp turn is when you see price forming what we call a fair value gap, and then price, we can say what price doesn't respect that fair value gap. Instead, price form another fair value gap in the same area, like here. Look on this area here. We had this fair value gap here. Okay, formed this fair value gap. Okay, that was the first respect to this fair value gap. Okay, instead price pushed very aggressively to the upside and fair value gap. That was another fair value gap. That's what we call sharp turn. When market respect it, but then form a fair value gap on the right. Okay, so we have a sharp turn right here. So I can mark, let me mark them as, so this is where we call a sharp turn. Now we have a sharp turn right here. And price, so for a fair value gap to be filled, we have to see what you call a 50% or the cool fill of that fair value gap. Now we just saw it's not a, to call an institutional entry drill. Institutional order flow entry from this, because you're going to have, it's not even 50% fill of this fair value gap. Now you have to wait for price to actually fill its 50%. So you can just use the tool of this rectangle where we had, you can just, didn't fill its 50%. Didn't fill this fair value gap to its 50%. You can see. Now we have the sharp turn. Another thing that I said was you look for the point of interest which had right here. You can see the turtle soup is this. This is a turtle soup. Okay, this is a turtle. That's a turtle soup, or we call a liquidity sweep. Now you can see price already and formed this sharp turn, and now we are asking ourselves, from where are we now? Are we going to trade from which gap as our entry? Personally, I don't like waiting much more. Market formed this sharp turn. You know, sharp turn is the strongest entry reason for you to take an entry. If you see this kind of thing, fair value gap for you to execute, but where do you put your stop? Put your stop, okay, for you to actually be safe. Okay, because fair value gaps are one of the very nice things to point of, or you can say nice PDRAs. Okay, according to ICT, they are the best point of interest that you 50% of the fair value gap, because price has not filled the fair value gap. Price always the fair value gap, but didn't fill to 50%. Always price, okay, most of the time price always use this inducement time. Just go and back test on a chart, you'll see. Or now price always revisit a point or a fair value gap that was filled not to its 50% or to its full fill. You will see that when the market is not filled to its 100% or not filled to its 50%, the market will always come down to the same fair value gap and will create some sort of liquidity sweep, like here. So this will be which fill this fair, and then I will use this fair value gap there, the 50% as my entry, but use the low of this order block here as my what? As my stop loss level, and take profit, target this, target 1 to 2, 1 to 3. Okay, don't always force trade. So you have a 1 to 2 trade like that. So you execute your trade from there. Okay, let's trade and see how the market reacts. Okay, yeah, we just try to consolidate the price trade. Okay, yeah, in order to take out some what our look of liquidity sweep. Price moved with this previous mitigation to the fair value gap, and then you can see how price went up 1 to 2. Okay, 1 to 2 done, and you can just, that's how you can use the minor structures to actually execute. So guys, I will prepare another video and explain more about the issues of fair value gaps, issues of not fair value, the issue of turtle soups, the issue of other concepts. Okay, we'll talk more about trading in the next video. So the video, and you can make sure you like, share, and don't forget to subscribe and hit that bell icon to actually be one of the first people to actually watch my videos when I upload them. Okay, so guys, thank you for your time, and I hope this was educational, and I hope you have added something.